This is the London FinTech Podcast, brought to you by your host, Mike Ballerman, bridging the worlds of suits and t-shirts, of finance and technology, bringing you insights, stories, and inspiration from the golden age of opportunity and innovation happening in London right now.
Hi, this is Mike Ballerman. It's a London FinTech Podcast, episode 98, brought to you in association with Blue Motor Finance and Smart Pension. And I'm delighted to be joined today by Anil, CEO of MarketInvoice, who joins us to talk about all things cash flow for UK SMEs. Anil was last on the show way back in LFP098 talking about invoice finance, which at the time MarketInvoice were the market leaders and still are. In the meantime, he's gone from doing a total of £500 million of business to just short of £2 billion and getting on for 100 staff. This time, though, we stretch him a little bit further and we zoom out to contextualise invoice finance in the fascinating wider topic of UK SME cash flow financing, as well as looking at invoice financing and where MarketInvoice has got to so far. Plenty to talk about, so let's get on with the show. Hi Anil, thanks for joining me today.
Hi Mike, pleasure to be back here talking to you again.
Excellent. Well, actually, it's not back here because we were back somewhere else when we did this a little while ago. But one of the symptoms of growth is getting involved in real estate and moving around London. We're now in Shoreditch. And to slightly sort of paraphrase what you said, I was asking you whether you do anything interesting, and you don't really have time because you're a fintech CEO to do anything interesting very much. But talking of moving around London, you said you also move around the world as such.
I guess, being an entrepreneur, you love doing new things, and in my spare time, I like to visit new countries. And if I look back kind of in the last 12 months, when I do get away, I like to go far away. So I've been most recently in Japan, which was a really fascinating place. I was skiing in Sapporo with some friends. Before that, last year, I also was in Indonesia, another fascinating place. Huge market, lots of interesting tech things going on, and everyone has like 2 mobile phones. And then also spent some time in India about 8 months ago. So, I love traveling, I love meeting new people. That's what keeps me fresh.
Oh, good. Well, we're slowly turning the London FinTech Podcast into a travel show, because in the episode before last, we had David Mercer, who was playing rugby at the North Pole. Last time's episode was Nigel Verdon on Costa Rica. And he tells me that Costa Rica hasn't had an army for decades, which is fantastic. And in Indonesia is not a country, but it's lots and lots of islands.
Yes.
Did you go to them all, or just some?
No. I spent some time in Jakarta and then in little regions outside it, and I met actually some interesting local entrepreneurs. They have their own version of Uber there, a delivery company called Gojek, which has grown really crazy. And the interesting dynamic right now is all the big Chinese tech companies are trying to get into the market, because it's a huge market. There's 350 million people in Indonesia. And it's a country that's kind of bypassed the desktop computer. They've all kind of gone mobile first.
Absolutely. It's time moves on. I was in Jakarta on a business trip 30 years ago, and I was hearing stories about local entrepreneurs at the time, and we were sitting outside having breakfast at some hotel on the Saturday morning. It was a rather tall hotel, and they were telling me that sort of life was relatively cheap at the time in Indonesia. I shall explain that before the sort of social justice warriors that listen to it, of which there are probably zero, get hysterical. In that I was told a few weeks back, someone had actually, shall we say, fallen off the roof of the hotel onto one of the nearby tables as a result of some sort of business dispute. And apparently the sort of cost for getting, this is 30 years ago, so inflation being what it is, it probably costs more now. The cost of getting somebody rubbed out at the time was $10, which I was so shocked by, I still remember that figure today.
Wow.
Anyway, not trying to pull you into non-PC stuff, I won't ask you what the cost of getting competition dealt with is in Indonesia now. So, going back to the day job and me getting off my impish mode, MarketInvoice has grown quite a lot over the last 2.5 years. And you've obviously had lots of exciting experiences along the way. In terms of the growth curve, what are the sort of some of the key things that you've learned by doing over the last 2.5 years that you'd like to share with the fintechs that are a little smaller than you, which is actually quite a lot these days? Quite a few fintechs haven't actually got to near 2 billion in volume.
Sure. So MarketInvoice, we started back in 2011, 2012, and we had one product, and it was a way for businesses to come and unlock cash against a single invoice whenever they wanted to. And that was our core only product for quite a long time. But then what we realized was that, we've been signing up these businesses and we've got to know our customer really well. We know the kind of business that we want to support. It's a business that's growing. It's got ambitious plans in terms of delivering on projects, services, goods, exporting. And we kind of were sitting there and they were telling us, actually, we'd love MarketInvoice to help us with other products.
And at the time, as I recall, you were focused quite a lot on intangible companies.
Yes.
Which found it harder to get such invoice financing from the usual sectors. I mean, if you're a metal basher and you've got sort of rivets or cars and factory and plant, you've got a lot of stuff that you can use as security and all that kind of thing. But you were, I recall, talking about like graphic designers or something.
Yes. Yeah, definitely. We started with smaller companies that were in the creative industries or the tech industries, companies that fell outside of the traditional bank credit scoring systems. But now, because we're a marketplace and the funding that we attract onto the marketplace in the beginning was quite highly priced. Investors wanted a big return. This was a new investment for them. As we've grown, we've added institutional funders, such as banks, onto the platform. They give us funds at lower cost of funds, which means that we can go after more mainstream companies. So now we're actually switching companies that were with the bank onto the MarketInvoice platform. And to add to that, we've now got 3 products. We have an invoice finance product for larger companies, which we call a confidential invoice discounting facility. We have selective invoice finance, which was our original product, and we also have a business loan now. So we can help smaller companies, and as they grow, they can grow with us. We can stay with them. So what we've seen is we've become a solution for businesses through their life cycle, not just a one-off transaction. We've got one invoice, we've got a problem. It's actually we're a holistic solution for those businesses.
Yes, that's interesting because at the time I think we were talking about one of your then very good customer, Scaramouche, who I'd introduced you long before I'd met you guys, actually, because I just heard your reputation, and Kenny and Co were trying to do business. And they've been incredibly successful ever since. And one of the problems for fintechs in general, in a way, is, you're helping a small company. What tends to happen is that a lot of them don't really succeed and sort of disappear. And then one or two, a bit like the water molecules, even in a cold glass of water, evaporate off. And suddenly they want sort of 100 times the size that you're doing. So you can be stuck in this little trap of, as it were, sort of, I don't know, kind of like being a junior school, taking all these kids in, and the best ones end up leaving.
Absolutely. So, I mean, Scaramouche and Fandango, which is a company that you introduced to us, is a great success. So it's a classic example of the kind of story that we like to help. We believe that if you help a company when it's small, they will always remain loyal and grateful to you. So, Scaramouche and Fandango, they make creams and other products. It was started by a young entrepreneur, I think in his late 20s, who had an idea, had a plan, started getting some orders from the supermarkets, and then landed a very big deal with an airline company, Etihad. And I still remember it. It's that moment when a small startup says, I've just landed the biggest contract of my career as an entrepreneur. And that fills them with a lot of excitement, but there's also a little bit of fear. You've got to make sure that all the pieces align, you get the funding, you pay your suppliers, you can deliver the goods. And we helped him at that critical juncture when other people were not willing to help him. And they went on to use us. And now, as you say, they I think they even made an acquisition. So I think they grew so much that they bought another company and they combined it. And so he's now running a much bigger company. And that was one of the reasons why we wanted to introduce a product for larger companies, because it's a shame to lose them. We want to help them along the journey. So we want to be there for the next phase of this company's development.
Excellent. Well, not for the first time in my life, I interrupted you at a very important point, which is sort of jogging backwards, which is that you were doing what you were doing when you started, and actually you did the sensible thing of actually talking to your clients, which most businesses do. And you did the thing which is slightly rarer, which is listening to them. And then you spotted other opportunities to grow. So we will return to MarketInvoice specifically at the end. In the meantime, then, let's just zoom out. Let's just put MarketInvoice to one side. Let's just pick your brains and knowledge of the marketplace. So there's something terribly prosaic and dull about the phrase UK SME financing. But of course, the reality of it, or rather the consequences of it or the lack of it, are not dull at all. The consequences are that millions of people are employed in these businesses, and these businesses need to grow and keep going forward. So actually, the reality is that this is providing sort of fuel for an important engine, not just the engine of the economy and that kind of stuff, but actually just people's lives, so that actually their company doesn't go bust and that their company can grow and all that kind of stuff. So taking a super step back, up, sideways, what are the main ways that UK SMEs finance themselves in the first place?
Yes, as you say, these SMEs, small businesses, are the backbone of the UK economy. They account for 60% of employment in this country and over 50% of GDP. So they're vitally important, as everyone knows. And I think that what you've seen is, while the underlying options for businesses remain the same, there are certain products that they can use to grow, where they can get these products from has changed. So there used to be 4 banks out there with very similar products for small businesses, with a lot of poor user experience, slow, the typical problems. And now, since fintech really began in London here, there's a lot more, many options, of which we're one, but there are others out there. To really kind of summarize, I guess, what are the options for an entrepreneur who's starting a business? Of course, in the very early phase, when you're writing a business plan and you're getting off the ground, typically you need to go out and find some seed equity funding. Many entrepreneurs save up and do it themselves, but they might have well-connected family members or friends. You go out and you get some equity. Then, when you're off the ground, typically you find a banking partner, and the banking partner might offer you a credit card, a business credit card. And it used to be that they would offer you quite a big overdraft, but since 2008, 2009, the overdraft option has really gone away for most businesses, where they might want £50,000 overdraft, they might only get a £5,000 or a £10,000 overdraft. Which means then that businesses need to either look for some sort of working capital loan as a way of funding their business. As they get orders and have invoices, they might look to invoice finance, which is a very powerful way to grow the business because you're borrowing against an asset, a future payment from your customer. Also, companies use things like mortgages and leasing. If they have machinery or if they have a property, they can mortgage against as a way of raising funding. Then companies get bigger and bigger. There's more lending options, more long-term loans. And then as the company gets, very big, they might think about listing or public bond markets, but that's obviously at a much higher size. This is a typical life cycle. And nowadays, I would really encourage entrepreneurs to go on, talk to people, go on the internet, do some research, because whereas there used to be 4 providers of these products, the 4 big banks, 80% of the market, there's now probably over 20 or even over 30 credible providers of finance that suit what you need. And the biggest barrier for businesses getting this finance is just awareness, just knowing what's out there.
Excellent. Right. Well, it sounds like you've covered the whole podcast in a very long sentence there, or paragraph. Just on picking a random one here, just to try and sort of bowl you a ball slightly spinning. One of the things about the past, let's say the 19th century for the sake of argument, is that you needed lots of money to create lots of physical things like railway lines and steam trains or Bessemer converters or something like that. And so actually it required a lot of capital in capitalists to create businesses. I'm mentioning graphic designers for the sake of argument, or hairdressers or whatever. These days, as we know, fintechs are probably very good examples. You don't need many Bessemer converters in your average fintech, nor do you need many steam trains or railway lines. Have you seen anything around the kind of fact that, I don't know, for the sake of argument, per dollar of output, less capital is required in the first place? Or is this much exaggerated?
I think the way that companies are spending money has changed. So it is absolutely true that you need less money to start a business now compared to even 10 years ago. So if you think of the cost of getting started, where you're hosting your data, on Amazon Web Services, the cost has really plummeted. So you can get a lot further as a company with less capital. And I think that as many entrepreneurs should actually think quite carefully about how much money they raise in their initial seed rounds, because maybe they can do things in a leaner way, in a cheaper way than they originally thought. But companies are spending, for example, the big expenditure we see not only for ourselves but also for other companies in the kind of technology sector is on people, right? There is a huge investment going on to find the best engineers, the best data scientists, and these are the people who are building the great software products that we're consuming. So whereas we might not be spending on factories and logistics, we're spending on talent and getting the best people here and giving them an environment where they can produce their best work.
Yeah, so presumably at some point someone needs to do some kind of mortgages on the people. You take a sort of a lien, a charge over their soul, and you can sort of lend the money for the cash flow for them or something like that. Okay, so that's fairly clear. And the reality is, regardless of how many, as it were, dollars per average dollar of added value you need to fund capital infrastructure or something like that, the reality is that, as every fintech knows, you keep having to do raises to get bigger. You still need money from somewhere. And in terms of the various factors that you've been talking about, you mentioned the fact that overdrafts changed in large part because of Basel III and how that sort of changed it for banks, not because the sort of, as the narrative had it 5 years ago in fintech, because banks are big, evil, stupid things, because they're not by and large. How are these sort of funding approaches, how have they been changing over time?
So there's definitely a shift from the banks for regulatory reasons, but also from risk management reasons, towards encouraging businesses to look more at asset-backed lending facilities. So what are the assets that you have in your business and how can you borrow against those assets? And a move away from unsecured long-term debt. And this makes sense. Many banks are fearful of the economic cycle. We have, Brexit on the horizon. There are many sectors which could be adversely affected by that if there was a recession coming out of Brexit. So, getting companies to think, okay, borrow against your invoices, borrow against stock, borrow against inventory, de-risks the proposition. And is actually quite sensible for the business as well, in the sense that they don't want to become over-leveraged during a potential downturn in the economy. So what we've seen then is asset-based finance, invoice finance actually growing. So it used to be about 15, 16 billion outstanding when we started, and it's now up at 22 to 25 billion or so.
Which is about 50% increase.
Yes, which is a big, sizable increase. And if you're a business owner going and talking to a bank manager about their funding options, you're going to hear more about invoice finance than you ever have done in the past.
Okay, so that's the super big picture. And as I haven't talked about invoicing finance for some time, let's look a bit more closely at the invoice financing, where you say you've got a couple of products and you can talk about how they work and how they relate in a minute. But this 22 billion, you were talking about a small number of players in the past. Do you have any idea of sort of the stats around the 22 billion? Like, for the sake of argument, half a dozen account for 50% of it or 90% of it?
No, when we looked at the data, the average size of business that's taking out an invoice finance facility is less than £10 million. So it is quite well spread across many, many businesses. Of course, larger companies, they have access to money markets, they have access to the public bond market. There are other ways that they can raise money. So invoice finance and factoring and inventory finance is typically used by smaller businesses. So that number is quite spread across lots of different customers. Of course, many companies still get their finance from their bank. Right? There is still the relationship manager at a bank, potentially, who's contacting these businesses and saying, do you want these options? But increasingly, as banks move to what they're very good at, which is servicing big companies, many of the smaller businesses are left without a direct relationship manager, in which case they have to educate themselves as to the options themselves online or through accountants. And that's why a lot of how we try and present ourselves is being the sensible choice for businesses, and talk about us with your accountant and look at us online, look at the other options, and that you're going to get a great easy product to use and a fast decision.
Yes, and I'm going back in the day when you were on the podcast 2.5 years ago, and you had this sort of single invoice discounting thing of which you guys are the fintech. That's obviously a really good model in some circumstances. In the circumstance of where someone, for the sake of argument, does, take a silly case, 1,000 invoices a day, it must get a bit tedious sending you 1,000 emails with an attachment.
Yes.
And an invoice. And Archover, of course, they were my brand partners up until last year. Their product was really around accounts receivable, which, without getting into accounting, is roughly, all of your invoices added together will lend against it, just so you don't have to send Anil 1,000 invoices a day. So have you moved on from that? Do people still have to send you 1,000 a day, or is this other product kind of cover that?
No, look, as a business, as you apply to us, if you want to do one big invoice with us, you can upload one big invoice. If you want to have a facility that's linked to your total stock of invoices, you can press a button, integrate your accountancy platform with our system. So if you're using Xero, you can connect with our system, and that takes all your information, your financial information, and gives you a limit, an amount of money that you can draw down. And that changes as your invoice ledger grows or falls. So it's really a permanent line of funding, which is what larger companies with many invoices prefer. We also have a business loan product. For example, if you're a company that is doing work before you can invoice, like you need some money to pay a supplier, to generate a good or a service when you're going to invoice out, you can take a business loan up to £100,000 and pay it back in weekly installments. Or if you're in between invoicing cycles and you need some working capital. And, we have great examples of companies that switch between using the loan and invoice finance. I'll give you an example. We have a great company called Smith & Sinclair. They're a new company. They produce these alcoholic pastilles, like alcoholic sweets, so great sweets infused with a shot of alcohol. And they needed some working capital last quarter before Christmas to get the stock all produced. They then shipped off the stock to places like House of Fraser and Selfridges, and then had an invoice and then took invoice finance. So we were basically their one-stop shop to power that growth, which is really exciting.
And I can see how that works for the borrower. In terms of the other way around for the investor, I did give up talking after a few years about risk because there wasn't really that much sort of interest in. Ironically, I feel in fintech as a whole and certainly in P2Ps about explaining the level of risk, or rather quantifying the level of risk. I still have the view that that all the peer-to-peers should say to their investor, statistically speaking, if you diversify, you will get from us 6% plus or minus 1.5% if you buy 100 loans or press the auto thing. And none of them actually do. And the other thing which we were talking about last time, which is a subtlety which is hard to include in even a quantification, was that there's a difference of modelling risk, which everybody does, and there's a very big difference in cash in, cash out. So your invoice finances are less than, say, 5 years, which you can get a 5-year peer-to-peer loan. Basically, what I'm talking about, you bung your money in, you will find out in 5 years' time if you stick it in one loan. But because the money turns over so fast in MarketInvoice, your returns are real returns.
Absolutely.
Very, very real returns. It's cash. It's like if you kept putting your own personal money in, you get it back, 60 days later or 45 on average or something. It would be a pile of cash. It wouldn't be, the model says my risk is X.
Yeah. So with our invoice finance products, from an investor point of view, they're very liquid. Money goes out, comes back within 45, 60 days. Then you redeploy, and at the end of the year, you can actually show a tangible profit that you've made, plus your principal back. So that's very attractive to investors. We have high net worths, we have family offices, we have institutions, we have banks, and they really love that product. So we're trying to originate more great companies for our investors to invest in. With the business loans product, your money is out for about a year, but you are getting weekly repayments. And again, that's also quite desirable. But as we grow our product base, we might start to introduce longer term loans. And there are investors who like that, who want to deploy money for over 1 year. But at the end of the day, it all comes down to the track record that we've produced, the returns that we produced over 5 years. I believe that lending businesses need to show stable returns to investors to build that confidence, to build that trust. That's a real cornerstone of our business. Risk management, understanding risk, and giving investors the comfort that they can drill down into the data and understand exactly what's going on.
And by and large, and I presume this applies to you guys as well, for the best peer-to-peers, just use the phrase for the sake of argument, it hasn't been a lack of available finance because there's quite a lot of finance going around. I mean, your chairman, Giles, is chairman of Zopa as well, and Zopa closed for a while to new money, and you were closed for quite some time. So there's plenty of money that will flow into fintechs and into P2P if they can expand faster. So by and large, the constraint has been the difficulty of finding more customers. Is that itself a question of time, in that, as time goes by, you find more customers and you grow the business? Or is it a question, I don't want you to comment on Zopa, of course, but is it a question a bit like Zopa that they're becoming a bank as well? Because there actually are advantages of being banks. So, originally the narrative in fintech was, this peer-to-peer model is far more efficient than these big, stupid, slow, hyper-regulated banks, and therefore will, eat their lunch and eat their dinner and take all their business off them. But actually, that hasn't happened. Is that just a question of time, or is it a question that we're now finding out, for the sake of an argument, the efficiency in a bank of taking £1 of deposit and turning into £10 of loans, and the efficiency in a peer-to-peer of taking £1 in and putting £1 out, and that it's there'll be some equilibrium level at some point in time. If we ran this fintech experiment for 1,000 years suddenly in a computer, you might find, for the sake of argument, fintech peaked out at 23.4% of the invoice market or something like that. What's your perspective on that?
No, I think that the peer-to-peer market is growing fast. You have to remember this is something that started at absolutely zero 5 years ago. So awareness is building every year. It's a matter of time. The big banks have been around for over 100 years. Give peer-to-peer fintech a bit more time. These are businesses that take a little bit longer to build because of the fact that money is being lent, track record needs to be built, trust needs to be built, awareness needs to be built. So peer-to-peer as a percentage of total lending is going to go up steadily every year. That's my prediction. The decision about whether you should be a marketplace versus a bank, each company has to go through that question. There are pros and cons of both approaches. As a bank, you need to raise equity and have regulatory capital and comply with a lot of regulation, but one advantage is that
you can make money up out of thin air.
You get access to deposits at very low rates. I would say that looking at MarketInvoice's experience, yes, we've been looking for more businesses, but we are looking for funding more also at the right price. There are a lot of investors who go into peer-to-peer and think, I should be making 10% net a year. That's in the low yield environment that we live in. That's just not feasible.
Anymore? I mean, you may have got that a few years ago.
Yes, you might have got that in the beginning when peer-to-peer was an unknown asset class and there was risk on the companies that were delivering these investment opportunities. But now, companies like MarketInvoice, Funding Circles, OPA, we've been around for a long time. We have proven that the asset class works, and that's why we're starting now to onboard investors who are saying, okay, I'm happy with 4% a year, 5% a year, and that allows us to go and attract bigger companies that would have been with a bank onto the platform.
So just wrapping up this section, having done the whole of sort of finance and narrowing down on the invoice finance point, and as you say, you do the loan product as well. What is, as a chief executive, your number one constraint on growth? What is the thing that stops you from being just under 2 billion today and, for the sake of argument, being 4 billion by Christmas?
I think every tech company has what we would call like a tech backlog. We have so many ideas, so many things we want to build, but we can't build them all at the same time. And we have, much smaller teams compared to bigger institutions, but we're also highly productive. And in smaller environments, you can, as an individual, you can contribute greatly and you can really move the needle. So a bottleneck for us is having more technical people here. We're recruiting for a lot of engineering talent, also data scientists to refine our risk models, and we could be doing a lot more if we had more great people. So that's something that I think about a lot, is how do we build a team, how do we find the right people, how do we coordinate them, and how do we keep the innovative culture when we were at 50 people as we scale to over 100. And that's something that I spend quite a lot of time thinking about.
Yes, that's a culture point that is an interesting one. I mean, I may mention in passing before that the work that I'm doing researching on fintech boards at the moment and how they manage the journey from basically corporate creativity, should we say, on day one to once you're FTSE, corporate governance and control. But this recruitment seems a really big thing this year, actually. I just pinged my elder daughter yesterday, actually. She said that she's at UCL doing physics. She was presenting a paper on quantum cryptography, and her mother had told me some time ago that Pippa has decided there's no way she wants to work for a large firm. So I pinged her this sort of very radical idea that maybe she should work in the smaller sector, in fintech sector and all that kind of stuff. And for the first time, actually, she did sort of show an interest. And for non-parents out there, there's a huge hurdle she's just gone through in that she's had to entertain this strange notion that dad actually might not be doing something boring and that dad actually might know something interesting about the world. And that's particularly strange for a teenage girl, because teenage girls certainly go through many, many years where they know that whatever dad knows, wears, thinks, likes in music must be wrong. So she's coming around to it. Anyway, before we wrap up the show and go specifically on to what you'd like more of, Anil, I've mentioned the last few weeks, actually. I think everybody in the last few have been recruiting. World First have been recruiting, LMAX Exchange have been recruiting, and I mentioned my two brand partners also recruiting. For those of you who haven't sort of rushed off to Blue Motor Finance and Smart Pensions website and got a job there already, I'm very sorry, but if you all have, then there'll be thousands of employees there and they'll be too busy to pay me. So a little shout out for Blue Motor Finance, who combine extensive experience with a fresh and innovative approach. Blue's award-winning technology has supported over £500 million of lending to over 50,000 customers. Smart Pension, who are fast, secure and free. Check out their UK workplace pensions at autoenrolment.co.uk. Okay, so then wrapping up, Anil. In life, generally, most people want more sex, drugs, or rock and roll, or all three. What's MarketInvoice at the moment and 2018 in terms of helping you grow? You've mentioned people, as David Mercer from LMAX Exchange said. He said, we never stop recruiting good problem solvers, and I suspect you guys don't stop recruiting them either, really.
Yeah, definitely. Out of the three, I think rock and roll.
That's the only one that's PC to say these days, actually. But it's very old-fashioned to say rock and roll, so it's PC but old-fashioned.
I think we've built a really great foundation at MarketInvoice. We have thousands of customers who love using our product. We have a great team coming from tech, from finance, from lots of different walks of life. We have a great innovative culture. We want to build new products, potentially go into new geographies. Also, a very important thing for listeners out there is that we stand also at one of the biggest changes in financial services is happening this year, and that's open banking. And it might get off to a little bit of a slow start as banks try and coordinate their efforts, but let's not underestimate how this could change the world that we live in. Data, bank account data, has been trapped within banks for hundreds of years. Now it's opening up, and companies like MarketInvoice are right at the forefront of this, and we will really benefit from this as companies say, okay, let me click a button, let me see what quotes I can get from people like MarketInvoice for my business finance. How can they help me? And that involves a lot of engineering build, a lot of tech build, a lot of data science, so we're looking for people who are motivated by that and want to be part of this once-in-a-generation change that's happening in finance. So the foundation has already been laid, but we can take this even further. And you're going to see a lot more from fintech companies over the next 5 to 10 years.
And in terms of channel to market and getting even more customers or partners or whatever things, from a professional perspective, you mentioned the accounting softwares, of people that are listening around the world, what kind of businesses would you like to hear from in terms of buddying up with you and helping you grow them,
Yes.
and you helping them grow you?
Partnerships are a super important component of our strategy. In fact, we are building a team that's dealing exclusively with strategic partners. Up to this point, we've done deals with accountancy firms, we've done deals with local councils to build awareness. We've done deals with some banks, so we're trying to help with bank referral. Where banks can't help, can they refer directly to us? We've plugged into the British Business Bank and some of the initiatives that they're doing. But we're looking to hear from any companies that help small businesses. So whether that's from the CRM, whether that's with advice, whether that's with software, because we can embed our products within each other and help businesses find the ecosystem of what they need to grow.
Excellent. Well, MarketInvoice has been one of these rare things in London fintech for many years now, the leader in its sector. I'm pleased to say that you're still the leader in your sector, which is a great record, and you're doing lots of interesting things going forward. And in terms of the podcast, it's always good to have you on, Anil, because what I aim to be doing with these podcasts is sharing the best advice from the best people in London so that many, many others can grow into big
Absolutely.
fintechs. We were talking about invoice-based finance, and asset-based finance, talking about quantum cryptography. Actually, we may be in a year's time talking about a balance sheet transfer, because I've got an asset I'd like to transfer from my balance sheet to yours. So if in a year's time you're after quantum cryptography, maybe you can reduce my financial liability and increase yours. In doing that, I think you probably don't want my other daughter, who's doing medieval literature essays at the moment, although that may become more relevant as time goes by. So thanks for that, Anil, and I wish you every success in the future.
Thank you very much.
Thanks for listening. If you have consulting, advisory/non-exec, or media needs in the FS or fintech space, get in touch with me at mike@londonfintechpodcast.com.
We could sit in a bender all day, watching the firelight dance, watching the firelight dance. We could walk in the mountains before dawn, watching a happy moonrise, watching a happy moonrise. To come away from the city, with the tarmac so dead and the people so sad. Come away from the city, with the faces so grey, with the pain of the everyday. We are wild like the mountains and the trees. Can you see what I mean? Can you see what I mean? We fit in between the earth and the sky. Kiss the city goodbye, wave the city goodbye, wave the city goodbye. The city goodbye. Watch the firelight dance with me. 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 Watch the firelight.